This podcast is for informational and educational purposes only and should not be construed as investment, tax, or legal advice. Any examples or frameworks discussed are general in nature and may not be suitable for all investors. All investing involves risk, including the possible loss of principal. Past experiences and planning approaches do not guarantee future results. One of the most expensive investment lessons that I've learned came from one of the smallest checks that I've ever written into a private deal. So about 7 years ago, I invested in a private real estate project that at the time appeared to check all of the boxes that I was looking for. I got introduced to the opportunity through someone that I knew professionally, and the sponsor was developing residential property in Southern California. On paper, everything looked solid. We had several conversations. I toured previous projects. The sponsor answered my due diligence questions well. Everything was in alignment. Everything was coherent, and the business model made sense too. So I decided to invest. But because it was my first time with this sponsor, I wanted to dip my toe in. So I didn't contribute any meaningful capital. I just went in for the minimum subscription amount. And I figured, well, if everything works out, then I'll just put in more the next time with this sponsor. And this made sense to me because I figure if something goes wrong, then it's not enough to hurt me in any real sense. But as it turned out, it wasn't enough for me to actually stay fully engaged after the wire transfer had gone through. So at that time, I viewed this smaller investment size as being a very prudent decision, and I felt like I was being disciplined. But there's this psychological problem that I wasn't really aware of at that time as it relates to tiny allocations in illiquid investments. I just stopped paying attention. The investment sort of became background noise. I didn't scrutinize the updates, no real follow-up questions. I called a couple times, but I didn't press too hard, even though I got the feeling something was amiss. So I didn't escalate my concerns very well. And I began to rationalize them away because I didn't want to deal with the burden, especially in the middle of COVID. And COVID made a big difference on this. The project required obtaining entitlements before construction could begin. So I always knew there was going to be a waiting period before there was cash flow, and then even longer before an exit opportunity. Like, that was the plan. But COVID pushed back the timelines, and that was understandable, but it let the investment get even further away from me than I feel like it otherwise would have. Things started to catch my attention when it became more about operational issues at a fundamental level. Financial statements were delayed and then eventually just not delivered. Same with partnership tax returns. They're never on time, and then eventually they just stopped altogether. Communication became really inconsistent. Sometimes I'd go the better part of a year without an update. And what started out as what could be chalked up to ordinary development delays started looking like a breakdown in basic business operations. Those are huge red flags, but I just walked right past them. It represented such a small portion of my overall net worth. I just wasn't feeling intense about it. It was just going to take too much time and effort to recoup the investment, if I was even able to. There's no clients in the deal, so I just had nothing to light a fire underneath me. But ultimately made me realize, like, this is really just going to go nowhere, is that I saw that the partnership entity, its registration, it had lapsed with the California Secretary of State. At that point, I'm thinking either there's no money left to even pay the Secretary of State, or the sponsor just decided not to maintain the basic business compliance for the entity. So after this all went down, it changed my thinking on private placements. I think there's really two ways you can go on this in terms of position sizing. You either don't invest at all, or you invest enough that you genuinely care about what happens and you're willing to put in the effort to rectify things if they go wrong. And when I say that, I'm not suggesting concentration in investments is always appropriate. Diversification still matters. But psychologically, I was in the danger zone where the investment was large enough that I should pay attention, but it was small enough that I didn't fully monitor it. And again, I'm not sure there's really anything I could have done even if I had a 10x investment compared to what I actually did, but I would have at least paid more attention and had kept my foot on the gas on getting the answers that I deserved. So being in that middle ground, it just created complacency for me. If I did have a 10x investment. I probably would have investigated the operational issues much earlier, pressed harder for financial reporting. I would have demanded accountability for tax filings, and probably would have coordinated with some other investors and just spent more time understanding what was actually happening behind the scenes. I basically would have behaved more like an owner instead of just a passive investor. So there's a misconception about due diligence around private investments, and it's that it all happens before the wire transfer. But I see now that ongoing monitoring matters just as much. And it's important because in illiquid investments, you don't have the benefit of daily market pricing that can expose problems quickly. If you see a public stock drop 40%, it gets your attention. But a private investment, it can just deteriorate for months or years, and investors can easily tell themselves that the delays are just temporary. So that's one reason why private investments require a much different mindset. You're not just underwriting the investment opportunity. You're looking at the integrity of the operators, their communication standards, their accounting discipline, their ability to navigate adversity, and how they treat their investors. Are they partners, or are they just people who are cutting checks or submitting wire transfers? And a lot of those qualities, they're tough to suss out before. They become more visible after the money is irrevocable. So here's a good mental exercise when you're looking at private placements. Ask yourself, if this investment started falling apart, how much time or energy or capital would I realistically be willing to devote to fixing it? I don't think hardly anyone asks themselves that question. They underwrite the financials, but they rarely underwrite the emotional or operational burden when things go sideways. And this is way different than purchasing a diversified index fund. Easily get out of, you're in control. But when you invest in a private deal, you're basically relying on a small group of people to execute a strategy competently and without public market accountability. And that deserves serious scrutiny. And even with that scrutiny, you still risk serious loss. So at this point, I've written off the investment both mentally and financially. Ironically, the tax loss offsets some capital gains elsewhere, so that softened the financial impact. But it was still an expensive lesson. It took some mental bandwidth, even though I didn't pay as much attention as I thought I should. It taught me a lot about human behavior, myself included. And again, it really changed how I think about position sizing and monitoring and engagement with private investments. And I'm willing to bet there's other people doing what I did before, where they invest enough just to participate, but they're not truly paying attention. So if you're evaluating a private placement, don't just ask, what happens if this works? Also ask, what happens if this becomes messy, delayed, or dysfunctional? And ask yourself something even more important, which is, would I still care enough to actively stay engaged when things go sideways? Because sometimes the most dangerous investment isn't the one that's too large. It's the one that's too small to fully command your attention.